All right, scholars, we're now going to take a look at a nice little exercise that deals with your concerns and contingencies and recording them. So we want to look at contingencies and how they get booked. So we've got a nice little story here, and we'll show you how and when you need to record them. Let's begin. Well, in this first item, you know what's going to happen? The actual owner of the company is going to get a letter from the IRS. So you're going to notice right here, there's an item, and it says to Mr. Fencer, Inc. from the IRS, and it's dated in December of year 7. The IRS has ruled in your favor regarding a tax dispute covering year 4, tax year. You can expect to receive a check in January of year 8 totaling $37,500 related to the overpayment of your tax liability. Thank you for your assistance in resolving this matter. So what are our points? Well, the employee is thrilled because he immediately thinks gain on year 7 income statement. But this treatment wouldn't be allowed under GAAP. Gain contingencies may be relating to items such as expected tax refunds regarding disputes or favorable litigation settlements. Gain contingencies are never recognized in the financials, but information about the potential gain may be provided in the notes if the expected gain is material, and the gain will be recorded when the check is received in the following year. Now look at this next one right here. We're going to have a CFO, and he's reading the newspaper, and it's entitled Big City Financial Times with the following headline, Tobacco Company Settlement Imminent. And then you read on, and it says Smoky Corp is expecting a judgment against them any day in a civil lawsuit filed in January of year 5. Word on the street says that the settlement could reach $25 million. So what's the point here? The CFO is sweating and in a panic because all he can think of is the loss that will be recorded on the income statement. Loss contingencies for an entity may relate to such items as litigation, lawsuits, collectability of receivables, warranties, environmental damages. Recognition and measurement of a loss contingency in the financial statements depends on their classification of probable, reasonably possible, or remote. We have to determine if the CFO should be sweating based on the following. Probable. If a lawsuit is likely to occur and the settlement can be estimated, then GAAP requires the contingency be recorded through a journal entry totaling at least the minimum amount and disclose the maximum. The income statement should reflect the loss. That's if it's probable. If it's reasonably possible, if previous conditions are not met, in other words, it's only possible, then a journal entry would not be recorded. Rather, a disclosure of the possible contingency will be made in the footnotes describing the contingency and the possible range of losses. And then we have remote. Remote, if the contingency is remote, no journal entry or disclosure is required, general rule, and ultimately, you don't have to look at it. So ultimately, what do we have here? Well, we got a couple of things. As we indicated, the CFO is sweating this out. It's probable, if it's reasonably possible, or remote. So let's take a look and decide this one. Help me out. If the fact pattern was this, and they're asking you to make a reasonable judgment, and it says that all he can think of about is the loss because the newspaper is already saying it looks highly likely that they are going to lose, and the judgment could come out, and it looks like it could be $25 million. Sounds like the loss is probable to me, and it's reasonably estimatable. Now, if they said damages could be between 10 and 25 million, then you pick the 10 million and footnote the 25 million, right? So this helps you understand how contingencies work. And for losses, they're automatically booked if they're probable and reasonably estimatable. Gains, we wait until we have the money in our hands. But you can footnote it if it's material. All right, ladies and gentlemen, I hope that helped you. You're ready now to try a full-blown problem.